Hello, friends, clients, and colleagues. Today is Tuesday, February 25th, and it's time for another 5 and 5 market update. This is Rich Siegel with ARQ Wealth Advisors and my new partner in crime and the newest partner to the firm, Carl Mariner. Hey, Carl.
Hey, Rich, how are you?
I'm doing great, thanks. Um, the overarching theme for this year is going to be the broadening out of the markets. As we know, the stock market has been driven by just a handful of mega cap tech stocks in the last couple of years, and we're seeing a dramatic um, change in recent weeks, recent months. And with that, we're going to jump right in. The first screen here is just going to be our disclaimer language, so feel free to pause and take a look at that if you'd like. And your 5 and 5 starts now. So I will take the first chart, Carl. Basically, feel a little bit vindicated these days. We always thought that having a portion of a portfolio overseas was important. And as you can see, for the first 2 months of the year, it's really starting to pay off. The S&P 500 has, not including today, even has returned about 1.9%, whereas emerging markets up almost 6, and Europe and Japan primarily, the blue, 8.25%. Amazing. Your thoughts?
Yeah, absolutely. I think you hit the nail on the head at the beginning. We've been waiting for the broadening out of markets. If you look at the past several years, the US stock market has just really dominated international markets, and we've felt that was pretty unsustainable. And so seeing some level of reversion in markets and some really strong international markets certainly helps for a manager that holds a diversified portfolio.
Agreed. Agreed. All right. The next one is our favorite Mag 7, Magnificent Seven. You know the names, NVIDIA, Microsoft, etc. This year struggling, down almost 3%. These two lines here represent the large cap growth portion of the US stock market and the value. The growth will be mostly technology, consumer discretionary, some healthcare, up only 1.5%. And you can see it's very highly correlated to the Mag 7. So it's really being driven down by these same names. Whereas look at the value, uh, utilities, financials, industrials, incredible outperformance so far this year. Much cheaper stocks. The earnings are strong, not as strong as these big cap tech names, but picking up. Your thoughts?
Yeah, absolutely. I think we touched on it a moment ago. You
Mhm.
know, where the Magnificent Seven goes, the US stock market has followed, and you're seeing that play out here very much in the US large cap growth space. It's probably a big piece of the reason we're seeing the S&P 500 underperforming international markets. We've been a big fan of value oriented stocks for a while. I think as the valuations on growth names, technology names, specifically the Magnificent Seven, has gotten very high. The risk to holding those names continues to get larger, and I think this is starting to prove that out.
Mean reversion is a real thing. And today you're looking at 37, 38% of the entire S&P 500 being dominated by 10 stocks make up that level. Way higher exposure and concentration than even the tech bubble. Not the same valuations, but higher concentration. So the idea of just 7 or 10 stocks driving the entire stock market is not a healthy stock market. This broadening out is a much better picture for investors. All right, moving on. Why don't you take this one?
Yeah, absolutely. What we're looking at here is a chart that shows the return of Microsoft over the past year relative to a balanced portfolio, a 60-40 mix of stocks and bonds.
Mhm.
And I think one of the takeaways here is that Microsoft has beat earnings expectations every quarter over the last year, and despite that, is still trading relatively flat.
Mhm.
So this is a big piece of the reason we really focus on diversification in the portfolios. Microsoft, in a lot of ways, is maybe the ballast to the Magnificent Seven. It's the more value-oriented name, higher free cash flow generation, lower price multiples, and despite all of those things, is still trading flat despite beating earnings. And so the risk in concentration in a portfolio is strong. We're seeing it across the Magnificent Seven. A little bit vindicating to see a balanced portfolio helping to immunize some of those risks.
right? And you can notice also just from the lines that the 60/40 strategy that we use for our clients, it's much smoother, right? Lower highs and higher lows. So safer, less volatile, and impressively, a much better result over the last 12 months.
Yeah, absolutely.
Let's shift gears and start talking about currency and yields.
Yeah, and I think this is an interesting slide. You know, we've talked quite a bit over the past several years around the idea of the strength of the US dollar and the impact that that has. And so the next two slides really focus on why the dollar is so strong, why it will likely continue to remain strong. And then the second slide is what the impact is to you as an investor. And so if you're looking at this slide, kind of the takeaway is that for US dollar assets like treasuries, the yield that you can get on those assets has really been much greater than equivalent yielding bond instruments in other developed market economies. So if all else equal, investors in the United States or in Europe or in Japan are able to hold US dollar assets like treasuries and outperform them, their local market assets by 2% a year, you're going to continue to see money flowing into US dollars. And so that continues to make a case for a strong US dollar.
So strong dollar, higher yields, stronger GDP growth than Europe, especially, and Japan. So yeah, we think the dollar may not stay at the exact same level, but should remain relatively strong for the near future at least. And then the final slide, let's talk about this, Carl.
Yeah, absolutely. So this is looking at the last decade.
Mhm.
The green line shows the value of the dollar relative to a basket of developed market
Mhm.
currencies. And over a decade, it's up almost 13%. That may not seem like a lot, but really the impact of that can be seen by the difference between the blue and the yellow line. So the blue line is an ETF of Europe, Far East, and Asia. So it's the developed market economies internationally in their local currencies. The orange line is a currency hedged version of the exact same portfolio. So by simply stripping out the impact of local market currency, you've effectively doubled your return over the last decade. To me, that's a noteworthy differential for having that strength of dollar.
Right. Historically, most asset allocators like to hold foreign stocks in foreign currencies. I think based on this new administration's agenda, America First agenda, all these tariffs, it's probably a good idea to take away some of the currency exposure. So what we've done recently in our strategies is to blend them with hedged and unhedged. So just in case the dollar remains super strong, we'll take advantage of the orange line, and then in case the dollar was to weaken a bit, we'll take advantage of the blue line. So that's a wrap. This has been really helpful. Nice change recently in the markets. Hopefully it will persist, and we'll speak to you soon.